While the internet is busy discussing World War III and changing profile pictures to flags, the real battle for your future is unfolding on the exchanges in Chicago and London, where futures are traded. The outcome of this struggle will determine whether you can retire in peace or if you'll be working at a diner until you're 90. The biggest energy crisis since the 1970s is approaching, and this isn't about politics, it's about cold, hard math. Donald Trump is back in the game, and his team is making it clear that he views Iran not just as a pariah state or a headache, but as an asset that can be used to redraw the global energy market. But Iran has no intention of sitting idly by. They have strapped on a financial suicide belt tied to the global economy and are holding their finger on the button. By the end of this material, you will understand what will happen to your money, retirement savings, nest eggs, and purchasing power when missiles start flying over the Persian Gulf. We are going to break down the nuclear option, and we're not talking about a bomb. We're talking about a choke point whose closure could stop a fifth of the world's oil supply and trigger a collapse in the global banking system. To understand why this explosion is inevitable, we need to return to the events of the last 4 years. The Biden administration played a very specific game of don't ask, don't tell with Iran. Formally, sanctions existed. The State Department even wagged its finger from time to time, but in reality, no one was watching. Iran was allowed to produce nearly 2 million barrels of oil per day and sell them directly to China, bypassing Western banks. This deal with the devil was necessary to keep gas prices down and prevent hyperinflation in the States. Right before the elections, the White House decided that after Russian oil left the market, they couldn't afford to lose Iranian oil as well. Therefore, they turned a blind eye to how Iran was rebuilding its reserves and financing its proxy forces. But now this deal is over. Trump and his team don't care about diplomatic niceties. They want maximum pressure too. Their goal isn't just to contain Iran, but to bankrupt it. They want to break the regime and start from a clean slate. But there is one problem. Iran has spent 40 years learning how to bypass sanctions and hide money. They have become true masters of the dark financial arts. Iran didn't just wait for sanctions to be lifted. They built a parallel economy. They have a massive ghost fleet of tankers, hundreds of old vessels purchased through shell companies in Panama, Liberia, and the Marshall Islands. These ships turn off their GPS trackers and vanish into the fog. They meet in the middle of the ocean, usually near the Singapore Strait or off the coast of Malaysia, and pump oil from tanker to tanker in the dead of night. Iranian oil is mixed with a small amount of crude from Oman or the UAE to hide its origin. And just like that, sanctioned Iranian oil turns into a Malaysian blend. It goes to China. Chinese banks pay in yuan or via barter, and the regime in Tehran gets its money. You cannot stop a ghost fleet simply by imposing sanctions on a couple of people in suits. You have to physically destroy the infrastructure that loads these ships. And here we come to the first flashpoint, a specific target that keeps hedge fund risk managers awake at night, Karg Island. If you don't know what this place is, you should find out as soon as possible. It is a tiny island in the Persian Gulf that barely fits a small town, but it is the most important piece of land in the Iranian economy. 90% of Iran's crude oil exports pass through the terminals on this island. This is Iran's Achilles heel. Pipelines run from the mainland underwater to the island, feeding massive storage tanks and berths where supertankers refuel. A very real scenario is currently being discussed in headquarters, and information about this is leaking into the financial press. If you know where to look in which this facility will be attacked, perhaps it will be an Israeli airstrike in response to a drone attack or a cruise missile strike led by the U.S. as part of the new maximum pressure. If Karg Island is destroyed, the consequences will be brutal and instantaneous. Nearly 2 million barrels of oil per day will vanish from the global market overnight. And then the guys from Wall Street at Goldman Sachs and Morgan Stanley will tell you on TV, don't worry, the Saudis have spare capacity. The UAE might open the taps. We have the Strategic Petroleum Reserve. Don't believe them. In a panic, everyone forgets logic. Markets react not to spreadsheets, but to fear. Today, the market is run by algorithms, high-frequency trading bots that scan headlines in milliseconds. If a headline flashes Iranian oil terminal destroyed, these algorithms aren't going to check Saudi Arabia's spare capacity charts or call the Department of Energy. They will start buying oil futures. They will buy fast, in massive quantities, and at any price. This will lead to a liquidity vacuum where sellers vanish and buyers panic. The price of Brent crude could skyrocket from $75 to $100, $110, or maybe even $120 within a week. Don't look at this as just a chart. Think about what this will do to your wallet. Gasoline at the pumps will rise to $5, $6 in typical states and up to $8 in California. But gasoline is a minor detail. Diesel, that's the real problem. Diesel is needed for the trucks that deliver food to stores, the Amazon vans that bring your packages, and the tractors that harvest the crops. When diesel prices soar to the heavens, the cost of delivering everything soars as well. Stores operate on razor-thin margins. They cannot afford a 30% increase in logistics costs. Therefore, all of this is passed on to you. The price of eggs, milk, furniture, electronics, everything will go up. This is the Trump paradox. He wants low inflation. He promised to lower prices, but his foreign policy, the desire to destroy Iran, could lead to the exact opposite result, imposing a massive inflation tax on American consumers as payment for a geopolitical victory. And while you're standing at the gas station cursing the price of gas, someone else will be popping champagne. War is a business, the oldest business in human history, and right now it is booming. Look at the defense sector. The conflict in the Middle East is essentially a weapons exhibition with live firing for American arms manufacturers. Every time the Iron Dome knocks down a missile, the manufacturer makes between $50,000 and $100,000 in profit. Each Patriot missile launch costs between $3 and $4 million. Who produces all this? Raytheon, Lockheed Martin, Northrop Grumman. These companies have order books filled for years in advance. If tensions with Iran escalate, the U.S. government won't just send diplomatic notes, they will send additional invoices. Congress will pass emergency aid packages, printing billions of dollars out of thin air to replenish stockpiles, and this money will flow straight from the Treasury into the accounts of the military-industrial complex. It is a transfer of money from taxpayers to the shareholders of defense companies. If you aren't investing in this sector, you are simply paying for the war without getting anything in return. But let's dig deeper beyond the obvious consequences. The market has already priced in a small skirmish. Traders aren't fools. They know that Iran and Israel hate each other, and they expect missiles, drones, the death of a few soldiers, and angry speeches at the UN. But the market has not priced in a retaliatory strike. Do you think Tehran will just swallow the blow, lose its main oil terminal, and surrender? Do you think the Ayatollahs will raise the white flag just because they've been deprived of their income? No. History shows that when a regime is backed into a corner, when it is threatened with financial collapse, it delivers an asymmetric strike. They have a lever, and that lever is geography. They control the northern coast of the Strait of Hormuz. Let's talk about the strait. Many have heard the name but have no idea what it actually is. It's a narrow strip of water connecting the Persian Gulf to the open ocean. At its narrowest point, it is 21 miles wide, but the shipping lanes, the deep water channels that huge supertankers must follow to avoid running aground are only 2 miles wide in each direction. 2 miles is nothing. You can stand on the deck of a tanker and see the Iranian coast with the naked eye. Every day, 20% of all oil consumed in the world passes through this narrow bottleneck, and not just Iranian oil, Saudi, Kuwaiti, Iraqi oil, oil from the UAE, and nearly all the liquefied natural gas from Qatar goes through here. If Iran feels that the regime is about to collapse, that the U.S. is trying to destroy them economically, they could block the strait, as they have threatened to do many times. Military experts and retired admirals scream in the news. They can't do it. It's suicide. The U.S. Fifth Fleet will clear it in a few days. Of course, in a naval battle, the U.S. Navy would win. But Iran doesn't need to defeat the U.S. Navy to close the strait. They don't need to sink every ship. They only need to sow panic among insurance companies. Marine insurance, centered in London, is the invisible hand that rules global shipping. No captain will sail a tanker worth $100 million with cargo of equal value without insurance. If Iran mines the strait or uses wolf pack tactics with fast boats and drones to damage a few tankers, Lloyd's of London will declare the strait a war zone. After that, insurance premiums won't just double, they will increase 1,000-fold, or insurance will be revoked entirely. If there is no insurance, ships do not sail. Oil stays in storage tanks in Saudi Arabia, and it doesn't matter how much oil the Saudis can produce if they cannot sell it. This is a nightmare scenario. This is a supply shock that will drive oil prices up to $150 or maybe even $200 per barrel. This will trigger a global recession that will begin the following Tuesday. Factories in Europe will close because they won't be able to pay for energy. Power outages will begin in Asia, and even America, despite its energy independence, will suffer from this price spike because oil is a global commodity. The price in Texas is linked to the price in Dubai. In this game, there is a player who stands to lose the most if oil stops flowing. And it's not the US or Europe, but China. Beijing imports a massive amount of energy from the Persian Gulf. They are the largest buyer of Saudi and Iranian oil. If the strait is closed, the lights will go out in Shanghai. Chinese industry, already struggling with property market issues and slowing growth, will face a catastrophe. This is why Beijing might stop this war or become the reason it spins out of control. We will talk about Chinese teapots, oil refineries, and the shadow banking system through which China pays Iran. But remember, Trump knows this. He realizes that pressure on Iran is a way to pressure China. It is a strike via a proxy. He hits Iran to hurt Beijing. Why is Trump doing this? Why wake the bear in the Middle East when he has plenty of problems at home? Because Trump is betting on the U.S. energy sector. Remember his mantra? Drill, baby, drill. It's not just a campaign slogan. It's a survival strategy for the economy. Today, the U.S. is the largest oil producer in the world. We produce more than Saudi Arabia and Russia. We are an energy superpower. And who wins when global oil prices skyrocket? The U.S. economy as a whole wins through an improved trade balance. Shale companies in the Permian Basin and North Dakota win. High oil prices are a wealth transfer mechanism. They pull money out of importing countries like China, Europe, and Japan and pump it into exporting countries like the U.S. In a cynical sense, an oil shock hurts American drivers who have to pay more, but it improves America's GDP figures relative to its competitors. It undermines Chinese industry due to rising energy prices, making goods more expensive. Europe, desperate for energy after losing Russian gas, will beg for supplies of American liquefied gas. This restores American dominance through chaos. Trump looks at the map and sees that the U.S. is the only large country that has everything it needs. In a world on fire, the king is the one who has his own gas station and his own store. But you need to look at your portfolio, because if you have a standard safe portfolio, the classic 60% stocks and 40% bonds, you are defenseless against this storm. Bonds fear inflation like fire. If oil rises, inflation rises. This is a direct correlation. If inflation rises, the Federal Reserve will not be able to lower interest rates. They promised to cut rates The market is waiting for it. But if oil goes to 120, the Fed might have to keep rates high or even, God forbid, raise them. Imagine what will happen. The economy slows down due to geopolitical risks. Perhaps a recession begins, and the Fed is forced to raise rates to fight inflation caused by the war. This is called stagflation. It is an economic nightmare. A hello from the 1970s. Stagflation kills stock portfolios because profits fall, a recession hits, and valuations drop as rates rise. Those who understand the situation are already taking positions, preparing for the shock. They aren't waiting for the news on CNN. Look at the options market. Everything is changing there. Traders are overpaying for call options on oil, meaning they are betting that prices will skyrocket. They are buying insurance against a crash. And don't forget about currencies, about the US dollar. Where do investors run when the world is going off a cliff? To the euro? No. Europe is not stable right now. To the yen? No. They run to the US dollar. It is the cleanest dirty shirt in the laundry basket. If war breaks out in the Gulf, the dollar will surge. At first glance, this seems good, but it will hit emerging markets. Countries like Turkey, Brazil, or Indonesia, which have taken on billions of dollars in debt, will suddenly find that servicing their debt has become 20% more expensive overnight. This could lead to a sovereign debt crisis that, starting in the Middle East, spreads to South America and Asia and collapses the banks tied to these loans. And we mustn't forget the shadow war, the invisible layer of conflict that can cause real damage even before the first missile is fired. We know that Israel and the U.S. have advanced technology for cyber warfare. Remember Stuxnet, the virus that destroyed Iranian centrifuges 15 years ago? It made them spin too fast while showing on the monitors that everything was fine. That was 15 years ago. Imagine what they have now. What if instead of a bomb on Karg Island, there is a cyber attack that shuts down pumping stations, or a virus that breaks the loading management software so no one can tell which ship got which oil? Or a hack that disables safety systems at refineries, causing massive fires? The market might not react to a cyber attack as violently at first because it is invisible and can be denied. Iran will say it was a technical failure, but it will affect supplies in exactly the same way. Oil will stop leaving the port. Keep an eye on the difference between the prices of Brent and WTI crude. Usually, there is a specific gap between them. If this gap widens, if Brent, the global price, becomes much more expensive than WTI, the U.S. price, it means the market is afraid of supply problems from the Middle East, but is confident in U.S. supply. This difference is your indicator. It will show you that insiders are pricing in a disruption in the Persian Gulf while the U.S. domestic market is flooded with shale oil. Watch this indicator and you will know about the trouble days before it is reported in the news. This is the era we are entering, an era of instability and great opportunity for those who know what to do. We need to talk about the secret sponsor of the Iranian regime that Washington prefers, not to mention, I am talking about Chinese teapots, small oil refineries. You might see this word somewhere in the Financial Times, but today it is the most important link in the global energy chain. We aren't talking about giants like Sinopec or PetroChina, which must follow international rules to avoid losing their place on the New York Stock Exchange. Teapots are independent plants, mostly located in Shandong province. They operate on razor-thin margins and make money in only one way. They buy distressed oil under sanctions at a huge discount. Iran cannot sell oil at market price because it is toxic. No one wants to deal with it. So they sell it to teapots with a discount of $10, $15, and sometimes $20 per barrel. This discount is the profit for the Chinese plants. They refine this cheap oil into diesel and gasoline that powers the Chinese economy. This is exactly the scheme Donald Trump intends to break with a sledgehammer. Trump's advisors know that you can't just sanction a ship, you have to sanction the buyer. The maximum pressure 2 plan includes going after the Chinese banks that process these deals. This is the financial equivalent of declaring war. If the U.S. Treasury puts a Chinese bank on the SDN, specially designated nationals and blocked persons list, it effectively cuts the bank off from the dollar system, which is equivalent to a death sentence. Until now, the U.S. has been afraid to do this because the economic consequences would be too severe. But Trump doesn't care about that. He views trade and finance as weapons. If he tells Beijing, stop buying Iranian oil, or we will cut your banks off from the SWIFT system, China will find itself in a difficult position. Either they abandon their partner in Tehran, which will lead to the collapse of the Iranian economy, or they risk financial ruin in their own banking system, which is already on the brink of crisis. And how does Iran get paid? They don't use bank transfers. The days of simple money laundering schemes are long gone. They have moved to a complex shadow banking system that is nearly impossible to track. We are talking about the Hawala system on steroids. Money moves through a network of exchange houses in Dubai, Istanbul, and Iraq. It moves in gold bars transported on private jets. It moves in tether. And increasingly, it moves through barter. China builds infrastructure, roads, and surveillance systems in Iran, and in return, it gets oil. No one sees the money. No one sends SWIFT messages. To break this circle, you need financial forensic specialists and harsh measures we haven't seen yet. But if Trump decides to impose secondary sanctions on the Chinese companies building this infrastructure, the construction will stop and the flow of goods will stop. The Iranian regime, which buys the loyalty of its population with these projects, will suddenly be left without money and will face the wrath of its citizens. Now let's talk about specific market sectors that will be tossed around like toys during a hurricane. Everyone talks about oil stocks, but the real casino is the maritime shipping sector. If you want to see true instability compared to which cryptocurrencies will seem like a safe haven, look at the tanker market. There is a company called Frontline Ticker and Scorpio Tankers Ticker, STNG. These companies own the massive ships that move energy around the world. A simple logic applies here. Chaos is profitable. When the Red Sea is closed due to missiles, ships must sail around Africa. This adds 2 weeks to the voyage. When the voyage becomes longer, the ship is occupied longer, which means fewer ships are available. The law of supply and demand kicks in, and ship charter rates skyrocket. We've already seen rates in crises rise from $20,000 a day to $100,000. If the Persian Gulf becomes a no-go zone or insurance spikes, tanker owners who are willing to take the risk will be able to demand any amount of money. We are talking about war premiums that will turn into massive dividends for these companies' shareholders. While the whole market is panicking, shipping magnates in Greece and Norway will be making a fortune. But there is a flip side to this coin. Airlines, they should be avoided like the plague. Airlines are essentially hedge funds that happen to fly planes. And their most vulnerable spot is aviation fuel. Fuel often accounts for 30-40% of an airline's expenses. If oil goes to 120, fuel prices will hit the roof. Most airlines hedge their costs, meaning they buy contracts to fix prices, but these contracts eventually expire. If we enter a period of high energy prices, traditional carriers, American, United, Delta, Lufthansa, will be crushed. Their profits will vanish. They will have to raise ticket prices, which will kill demand because people won't have money anyway due to inflation. It's a death spiral. If you are holding airline stocks thinking that travel is returning, you are looking in the rearview mirror when you should be looking at the missile flying into an oil refinery. The transport sector is the first victim of an energy war. Back to the Strait of Hormuz, there is a detail that many analysts overlook. They talk about oil, but forget about gas. Qatar is a small country on a peninsula next to Saudi Arabia. It is the world's largest exporter of liquefied natural gas. They share a massive underwater gas field with Iran, and all of Qatar's gas must pass through the Strait of Hormuz. Who buys this gas? All of Europe. Since the start of the war in Ukraine and the explosion of the Nord Stream pipeline, Europe depends on LNG more than ever. Germany even built floating terminals to receive this gas. If Iran mines the strait or threatens Qatari tankers, the gas will stop flowing. Think about what this will do to the European economy. They barely survived last winter without Russian gas because the weather was mild, and they paid huge sums for LNG. If you remove Qatari LNG, gas prices in Europe will explode. German industry, BASF, Siemens, automakers simply won't be able to operate at such prices. Factories will have to close. This will trigger a deep recession in the Eurozone. If you hold European industrial stocks or the euro itself, you are holding a ticking time bomb. The euro will fall against the dollar because the US has its own gas and Europe does not. This is why the Trump trade isn't just about buying US stocks. It is a bet against the European economy. It is a bet that energy independence will make America the last man standing while our allies in Europe wither away. We must also remember Russia. Putin and the Ayatollahs have created an axis of evasion. They share experience in bypassing sanctions. They trade weapons. Iranian drones are killing soldiers in Ukraine right now. If Iran enters a war with the US and Israel, Russia will not stay on the sidelines. They might not send troops, but they can provide intelligence and supply advanced anti-ship missiles. Imagine if Iranian forces use a Russian hypersonic missile to hit an American destroyer. This completely changes the situation and drags the U.S. into a direct conflict. It is in Russia's interest for oil prices to skyrocket. Every dollar of price increase provides additional millions of dollars to fund its war machine. Chaos in the Middle East is the best thing that could happen to Moscow. It distracts the West, drains U.S. resources, and raises the value of Russian exports. This interconnected system of alliances creates a loop of instability. Trouble in one place exacerbates problems in another. If the price of oil rises, inflation hits the U.S. If inflation hits the U.S., the Fed keeps rates high. If rates stay high, the U.S. dollar pressures the Japanese yen and the Chinese yuan. If the yuan weakens, China dumps U.S. treasuries to protect its currency. If China dumps treasuries, yields in the U.S. rise, and the American housing market grinds to a halt. Do you see how it works? You cannot look at everything in isolation. You cannot say this is just a Middle East problem. No, this is a global economic crisis disguised as a war. The last thing to remember is uranium. Everyone is looking at oil, but those who understand the situation are watching what happens when everyone realizes how vulnerable oil supplies are. When something threatens the Strait of Hormuz, countries start panicking about energy security. They look for an energy source that doesn't require a tanker arriving every week. And then they remember nuclear power. Investing in uranium is the best protection against chaos in the Middle East. Shortly, I will tell you which companies stand to profit when the panic shifts from where do we get oil to how do we get away from oil. But first, we need to deal with the consequences of maximum pressure on the U.S. domestic front. Trump wants to produce more American energy, but that takes time. You can't just start producing 1 million barrels of oil tomorrow. Shale wells deplete quickly. To maintain production, you must constantly build new ones. But Wall Street banks, under pressure from environmental activists, have practically stopped lending to oil companies. They've cut off the oxygen. So even if Trump says drill, the oilmen might answer with what money? A lack of capital means supply cannot grow as fast as it used to. In 2018, the American shale industry could increase production in a few months. In 2025, it might take a year. This time gap between the geopolitical shock and the market's reaction is the kill zone for the global economy. That is where prices skyrocket and destroy demand. And let's be honest, there is a political aspect here. Trump uses tariffs as a cudgel. He has already threatened to impose a 60% tariff on Chinese goods. If he adds to that secondary sanctions against Chinese banks, he effectively disconnects the two largest economies in the world from each other. This is the end of globalization as we know it. We are moving toward a world of fragmented trade blocks. The dollar bloc, US, UK, Canada, and maybe Europe if they behave, and the BRICS bloc, China, Russia, Iran, Brazil. If you invest in international companies like Apple or Nike that depend on global supply chains, you will be caught between two fires. Apple won't be able to sell iPhones in China if the US imposes sanctions on the Chinese central bank. Decoupling is no longer a theory, it is the reality for the next 4 years. Stop thinking like a typical investor. Think like a wartime general. In peacetime, the one who knows how to save money wins. You want a company with minimal inventory and just-in-time delivery. But in wartime, the one who has excess inventory wins. You need a country that has its own resources. You need an asset that doesn't depend on anyone. Gold is the ultimate defensive asset in this world because it is the only asset that is not someone else's debt. If Iranian banks collapse, if Chinese banks are sanctioned, if the euro falls, gold doesn't care. It sits in a vault. Central banks know this. China has been buying up gold for 2 years now. They are preparing for the day they are cut off from the dollar system. We are witnessing a game of chicken between two nuclear economic superpowers unfolding on a narrow strip of water somewhere in the desert. And the scary part isn't that one side wants war, but that both sides could miscalculate. Iran might decide it can lightly mine the strait to send a signal and accidentally sink an American warship. Trump might decide he can bomb just one facility to show strength and accidentally trigger a regime collapse, after which the region plunges into chaos. There is no margin for error. And if there is no margin for error, do not play for the downside. Buy what grows when the world is going off a cliff. Now, I will give you a concrete plan of action. We've talked about the problem and analyzed the causes. Now let's talk about the solution. I will tell you about the war portfolio that will protect you from inflation, currency devaluation, and supply chain issues. We will talk about uranium, about defense companies developing drones and cyber weapons, and why holding cash is not the best idea. Let's return to uranium, because that's exactly what those who understand the situation are talking about right now. While everyone else is panicking over oil, oil is a short-term game, a reaction to the news, but uranium is a long-term play that will determine how we survive over the next 10 years. And here is the logic that the market is only beginning to realize. If war breaks out in the Middle East, what will happen to all the Western countries? They will realize that their energy security is a fiction. They will realize that they cannot rely on tankers passing through a narrow strait controlled by a hostile regime. They need energy that does not depend on the Persian Gulf. And that is when they will remember nuclear power. This is no longer about ecology. The fairy tales about wind and sun die in the face of reality. This is about the survival of the country. France understands this. China understands this and is building new reactors faster than anyone in history. And the tech giants understand it too. Look at the connection between war and artificial intelligence. It sounds like science fiction, but it is a reality affecting capital allocation right now. Microsoft, Amazon, Google, Meta, all of them are in an arms race, building massive data centers that consume as much energy as small cities. AI is like a vampire. It sucks up energy. A single request to ChatGPT burns 10 times more electricity than a standard Google search. Now multiply that by billions of requests a day. You cannot build a data center that consumes a gigawatt of energy on solar panels that stop working when the sun goes down, or on wind turbines that don't spin when there is no wind. You cannot build the future of the economy on unstable energy. Let's conclude this by looking at the grand strategy and the philosophical shift happening right now. We are witnessing the end of the peace dividend. For 30 years, since the fall of the Berlin Wall, we lived in a fantasy world. We believed that history had ended. We believed that globalization would stop wars because trade partners don't shoot at each other. We built supply chains that were incredibly efficient, but incredibly fragile. We outsourced our manufacturing to China because it was cheap. We outsourced our energy to Russia and the Middle East because it was cheap. We outsourced our defense to the U.S. security umbrella. That era is over. It is dead. It is buried in the ruins of Gaza and the trenches of Ukraine. We are entering the era of security first. Security is expensive. Redundancy is expensive. Building a factory in Ohio is 3 times more expensive than in Guangzhou. Drilling for oil in the North Sea is more expensive than pumping it from the Saudi desert. Protecting oil tankers with destroyers and frigates costs billions. This means that structural inflation is not going anywhere. The 2% inflation target the Fed talks about is a fantasy from a bygone era. You need to adjust your expectations. We are moving into a world of higher costs, higher friction, and higher volatility. The just-in-time economy is being replaced by the just-in-case economy. Companies will hold more inventory. Governments will create strategic reserves. This ties up capital and drives prices up. Donald Trump understands the levers of pressure. He is a deal-making animal. He knows that in a chaotic, broken world, the United States actually holds the best cards. We have the food, we have the fuel, we have the guns, and we have 2 oceans protecting us. He is ready to break the China shop and disrupt the global order because he believes the U.S. can pick up the pieces better than anyone else. A strike on Iran, if it happens, or the economic strangulation of their oil trade, is the first move in a much larger game to checkmate China. He wants to force capital to return home. He wants to make the rest of the world so dangerous, so unstable, that money flees Europe and Asia and flows into American factories and American energy projects. This is a strategy of aggressive isolationism. But when elephants fight, the grass suffers. You are the grass. The small investor, the pension fund, the family savings account, these are the victims of economic war. If you don't make the move, first institutions move slowly. They are tied up by committees and compliance departments. They need to hold a meeting just to decide to sell a bond. You are agile. You can restructure your portfolio today. You can hedge your risks before the market opens tomorrow. You must decide right now, are you an investor who hopes for the best or an investor who prepares for the worst? The hope strategy is the 60 over 40 portfolio, the belief that the Federal Reserve will back you up and the belief that the world will return to normal is a strategy of denial. The preparation strategy is the war portfolio. Long energy, especially U.S. domestic producers, immune to the Strait of Hormuz. Long defense, especially drone and cybersecurity companies building the future of war. Long real assets, gold and uranium to hedge against currency devaluation and energy shocks. And short fragile currencies, the euro and emerging markets dependent on imported oil. This is a portfolio that assumes friction, conflict, and inflation are features, not bugs, of the New World Order. This is not about being an alarmist. It is about being a realist. An alarmist builds a bunker and hides. A realist analyzes the board, identifies the threats, and positions themselves to profit from the inevitable volatility. War transfers wealth. It transfers wealth from the unprepared to the prepared, from the passive to the active, from the currency holder to the asset holder. The fuse is lit in the Persian Gulf. The ghost fleet sails in the dark. The algorithms are programmed and waiting for the headline. You have the information. You see the map. The question is whether you have the courage to act on it before the market prices in the catastrophe. Because once the missiles fly, once the strait closes, once the cyber attacks hit the banks, it will be too late to buy insurance. The house is already on fire.